Everybody, welcome to inventory part 11. We're going to talk about inventory costing and the background and the theory behind it. So what exactly is inventory costing? So when a sale is recorded, we're debiting accounts receivable, we're crediting sales, and then we're going through and debiting cost of goods sold, which is an expense, and we're crediting inventory. The point behind inventory costing is really going through and saying, okay, we have our inventory account here. And then what amount are we going to be assigning over here to our cost of goods sold? So again, just as kind of a reminder, this is by far one of the most important transactions that you, or one of the most important entries that you know. And again, when inventory is sold, we're debiting accounts receivable, we are crediting sales revenue, we're debiting cost of goods sold, and we're crediting inventory. Now, when it comes to inventory, what we're going to be looking at is we have our beginning inventory plus our inventory purchases. When we have our inventory plus our inventory purchases, this is going to be giving us something called goods available for sale, or gas. Okay. So as we look at this for inventory, we have our beginning inventory plus our purchases gives us goods available for sale. Now, when we go through and we sell inventory, right, we're going to be crediting inventory right over here. So we're going to basically credit our inventory, and this is going to go to cost of goods sold. And then I'm debiting my inventory, my cost of goods sold right over here. So this is what's happening in terms of inventory sales transactions. Okay, so we've got, we're focused on an inventory costing is figuring out the dollar amount that we're going to be going through and assigning to cost of goods sold. Now, when I take my goods available for sale, subtract my cost of goods sold, what is that going to give me? This is going to give me my ending inventory. And this is where we're getting to a very important point. When I'm going through and writing this out as an equation, what I can say is that my beginning inventory plus my purchases is giving me my goods available for sale, or gas. So we've got this first part of our equation right over here. Then what I can also say is my gas minus my cost of goods sold, or COGS, is going to equal my ending inventory. Now, what's going to become very important in these questions that we do is we can rewrite this multiple ways. If I add cost of goods sold to both sides, I get gas equals ending inventory plus cost of goods sold. If I flip it, gas minus ending inventory is equal to my cost of goods sold. This part here is extremely important because as we go through and handle these different types of inventory questions, we're going to have a lot of different ways we can go through and check our work. So understanding the relationship here is going to be very, very important. So we're going to talk in the next video a little bit more about FIFO and LIFO, but before we even get there, what's very important just to kind of remember is what is the whole purpose of inventory costing? We're trying to figure out the dollar amount of inventory we're sending over to cost of goods sold. So with that all being said, I want to thank you for joining me here today. Please leave any questions you have below, and appreciate you liking and subscribing to these videos. And I look forward to seeing you on the next video. Have a great day.